We all know the financial cliche.
Right.
There's no such thing as a free lunch. It's like the first rule of efficient markets.
Right.
But if you talk to finance academics, almost all of them, they will agree on one single exception to that rule: diversification. You can't control what returns the market gives you, but you, the investor, can absolutely control how you structure your risk.
And that control is just, it's everything. We're talking about asset allocation, you know, the fundamental strategic decision of how you divide your portfolio.
Across things like global stocks, bonds, cash, maybe real estate.
Exactly. It is the foundational act of managing risk. And it's what separates a speculator who's just chasing a hot stock from a serious investor who is building, well, a resilient, long-term financial plan to meet their goals.
Today, that's what we're doing. A deep dive into the math behind that decision. We're going way beyond the simple 60-40 mix.
We're looking at the quantitative bedrock that the biggest institutional investors use, the models that really define what risk is.
The theories that prove diversification really is a free lunch. And the academic debates that, frankly, explain why so many active stock pickers fail.
It's the knowledge that separates participants from architects.
Absolutely. And speaking of architecture, if you are looking to constantly upgrade your own financial knowledge and get expert insights like these, you should definitely subscribe to Money Mindset today.
So our mission today is to walk you through the revolution of modern portfolio theory, look at the 4 core strategies institutions actually use, and then get into that big academic debate on what really drives performance.
And finally, we'll look at how modern modeling helps us manage not just the average outcome, but the critical downside risk.
Which is what really matters.
Let's start at the beginning, the concept that really changed everything in modern finance. Modern portfolio theory, or MPT.
Yeah, this is the work of Harry Markowitz back in 1952. And it was just a massive, massive shift in how people thought about investing.
Before Markowitz, it was pretty simple, right?
Yeah.
It was all about finding the one stock that was going to go up the most.
Almost entirely about maximizing return, yeah. Investors looked at individual assets, you know, which stock, which bond looks like it's going to be the winner. Risk was sort of a secondary, fuzzy thought.
They thought about risk in isolation.
In total isolation. Markowitz came along and formalized what we now call mean variance analysis. And his insight, which sounds so simple now, was that an asset's risk should never be assessed on its own.
It only matters how it adds to the risk and return of the entire portfolio.
That's the key.
So MPT gave us a way to actually quantify risk, to put a number on it. How does it define risk mathematically?
Okay, so MPT defines risk as the variance of returns, or the square root of that, which is the standard deviation. Most people just call it volatility.
So if a stock returns exactly 10% every single year, its volatility is 0.
Right. But if it returns, say, plus 30% one year and minus 10 the next, the average is still 10%, but the volatility is super high. MPT is built on the idea that rational investors will only accept that higher volatility if they are paid for it with higher expected returns.
It makes investing a rigorous, quantifiable trade-off.
It does. But that's just for one asset. The real magic, the real power comes when you start combining assets.
And this is where correlation comes into the picture.
Exactly. When you look at the risk of a whole portfolio, its total variance depends way more on the covariance or the correlation between asset A and asset B than it does on their individual risks.
Covariance is just a measure of how two things move together, right?
Pretty much.
Yep.
If asset A always goes up when asset B goes up, they have a high positive correlation. If A goes up when B goes down, they're negatively correlated.
And this is the engine that drives that famous free lunch. Explain how that works. How does correlation give you this risk reduction benefit?
The math is really explicit on this. If the correlation between two assets is anything less than perfectly positive, so a correlation number less than 1, then combining them automatically reduces the portfolio's overall standard deviation.
Wait, to a level that's below the simple weighted average of the two.
Below the weighted average. And that reduction in risk, which you get without giving up any of your expected return, well, that is the free lunch.
I think we need a concrete example here.
No.
Let's say I have two assets. Both have a 10% expected return and 15% volatility. If they're perfectly correlated at 1.0, what happens?
Well, then there's no benefit. The combined portfolio risk is still just 15%. Think of it like owning two nearly identical tech stocks, say 2 semiconductor companies.
Okay.
When the economy is great, they both do great. When there's a chip shortage, they both tank. Their correlation is super high, maybe 0.8 or 0.9. The diversification benefit is tiny.
But now let's say I swap one of those tech stocks for a long-term U.S. Treasury bond.
Now you're talking. Historically, treasuries often go up when stocks go down. That's a negative correlation, maybe minus zero point 0.2.
So even though the bond has its own risk, its own volatility, when my stock is having a really bad day, the bond is probably having a good day, and it cushions the blow.
Precisely. The math equation for portfolio variance has a term in it that's basically the volatilities multiplied by the correlation. When that correlation number gets smaller or negative, the whole term shrinks and it pulls down the entire portfolio's risk.
So you don't even need negative correlation, just anything less than perfect.
Anything less than 1 gives you a measurable, mathematically proven reduction in risk.
Which makes that hypothetical case of zero correlation so interesting.
Oh, it's the theoretical ideal. If you could find an infinite number of assets that had absolutely zero relationship to each other mathematically, as you add more and more of them to a portfolio, that company-specific risk, the idiosyncratic risk, it just approaches zero.
You'd basically be left with only systematic risk, the risk of the whole economy.
And that explains why a rational investor doesn't get paid to take on risks they can just eliminate for free by diversifying.
That is a huge takeaway. If you're just holding a few stocks, you are taking on uncompensated risk. A diversified fund just gets rid of that risk for you.
That's the core MPT insight. And it brings us to the visual roadmap Markowitz gave us. The efficient frontier.
Okay, walk us through this again. The efficient frontier.
Imagine a chart. On the bottom axis, the horizontal one, you have risk or volatility. On the vertical axis, you have expected return.
Okay.
If you plot every single possible combination of risky assets, stocks, commodities, real estate, everything, you get this big sort of football-shaped cloud of dots. We call it the Markowitz bullet.
Right, and the upper left edge of that bullet, that's the frontier.
That's the efficient frontier. It's the curve that represents all the portfolios that give you the absolute maximum expected return for any given level of risk.
And any portfolio that falls inside the bullet, below that curve, is, just bad.
It's suboptimal. Yeah. If your portfolio is inside that bullet, it means you could either move straight up and get more return for the same risk, or move straight left and get the same return for less risk. You're taking on risk you don't need to.
But real-world portfolios aren't just risky assets. There's always the concept of a risk-free asset.
And this is where William Sharpe built on Markowitz's work. Sharpe introduced the risk-free asset. It's theoretical, but in practice, we use things like short-term government T-bills.
Because they have basically zero volatility and no real default risk.
Exactly. And when you add that risk-free asset into the mix, it fundamentally changes the graph. The efficient set is no longer a curve.
It becomes a straight line.
A straight line. We call it the capital allocation line, or CAL. You draw a line from the risk-free rate on the vertical axis, and you make it just touch the edge of that Markowitz bullet.
The tangent point.
That tangency point. That point is the single most important portfolio of risky assets for every single investor. We call it the tangency portfolio.
Which leads to this beautifully simple, but I think really contentious idea, the one-fund theorem.
The theorem is elegant.
Yeah.
It says once you've found that one perfect tangency portfolio, every investor, no matter how risk-averse or risk-seeking they are, should hold the exact same mix of risky stuff.
Your personal feelings about risk don't change what the best combination of stocks and bonds is. It only changes how much cash you hold alongside it.
That's it.
Wait.
Okay.
If the one-fund theorem is mathematically true, why is there so much debate about asset allocation? Shouldn't everyone just buy that one fund?
That is the essential real-world problem with MPT. The theory is perfect, but the inputs, expected returns, expected volatility, expected correlations, they're all just forecasts. They're guesses based on history.
And the true market portfolio would have to include everything, right? Like real estate, art, even your future earnings potential.
Which is impossible to own. So the real challenge for investors isn't picking stocks. It's constructing the best, lowest cost proxy for that theoretical tangency portfolio using the assets we actually have access to.
So the big takeaway for our listeners is find the best, most diversified proxy for that portfolio, probably a global market index fund, and then just decide how much of that you want to own versus the risk-free asset.
Exactly. If you're aggressive, you borrow to own more of the risky fund. If you're conservative, you hold more cash. You're just deciding where on that straight capital allocation line you want to sit.
Okay, so we've got the why, the math that says you have to diversify. Now let's get into the how. How do institutions actually put these theories into practice?
Right. It's not just one single plan. We can really break it down into 4 main strategic approaches, and they exist on a spectrum from super passive and long-term to very active in short term.
Let's start with the anchor, the big one, strategic asset allocation, or SAA.
SAA is the bedrock. It's the purely passive, long-term approach. We're talking a time horizon of 10, 20 years, or even longer. These portfolios are built on long-run, equilibrium views of the market.
So this is your core policy portfolio. You set your 60-40 or 70-30 mix, and you just stick with it.
You stick with it. You rebalance periodically back to those target weights, but that's it. The assumption here is that over the long haul, markets are pretty efficient, so you should just ignore all the short-term noise.
Okay, but what if you want to react a little bit to what's happening in the economy? That takes us to dynamic asset allocation, or DAA.
DAA keeps that long-term SAA as its baseline, but it allows for systematic adjustments based on what's happening in the medium term. Think of SAA as your final destination on a map, and DAA is making small course corrections based on the weather forecast.
What's a trigger for a DAA adjustment? Give me an example.
A classic one would be a belief that the economy is entering a late cycle phase. You're seeing rising inflation, maybe the yield curve is flattening.
Okay.
A DAA approach wouldn't mean you sell all your stocks, but you might systematically tilt away from sectors that are really sensitive to interest rates, like financials, and maybe add a bit more to defensive fixed income for the next year or so. The key is that the adjustments are modest and rules-based.
Not just a gut feeling.
Exactly, which is the big difference between DAA and the next strategy, tactical asset allocation, or TAA. TAA feels much more like making active, discretionary bets.
This sounds like market timing.
It is. TAA is the most aggressive and shortest-term strategy. It's usually working on a horizon of less than a year, making these big, active calls to try and capitalize on what you think are short-term mispricings in the market. This is pure alpha hunting.
So a TAA manager is doing things an SAA manager would never dream of.
Right. A TAA manager might, for example, think the euro is temporarily undervalued because of some political drama, so they'll massively overweight European stocks for a few months, completely deviating from their long-term strategic plan.
And the sector rotation example is perfect for this, right? The idea of moving between cyclical and defensive stocks.
Exactly. You look at the sectors. You have defensive ones like healthcare and utilities that do better when the economy is weak, and you have cyclical ones like financials and consumer discretionary that boom during expansions.
So a TAA manager who thinks the Fed is about to pause rate hikes might.
They might pile into financials and real estate, betting on a short, sharp rally. They are actively trying to time that pivot. An SAA investor just ignores all of that noise.
Okay, so TAA is discretionary, based on a manager's view. But there's a more modern approach that tries to make these adjustments systematic. That's time-varying asset allocation, TVAA.
TVAA is a really powerful modern approach. You see it in methodologies from firms like Vanguard. Unlike TAA, which is a short-term gut call, TVAA is systematic, repeatable, and focused on the medium term, usually a 10-year forecast.
What makes these 10-year forecasts time-varying?
They are heavily, heavily influenced by current market conditions. So if the S&P 500 is trading at a really high price-to-earnings ratio, the model says, hey, the odds of getting the historical average return over the next decade are much lower now.
So SAA says, historically, stocks return X, so we'll plan for X. But TVAA says?
TVAA says stocks are so expensive right now that the expected return is actually X minus Y, so we need to adjust our strategic mix down today.
It's a systematic deviation based on current prices.
Exactly. It avoids the behavioral bias of a TAA manager, but, and this is a huge caveat, investors who use TVAA are explicitly taking on model forecast risk. You are placing a bet that the mathematical engine generating these forecasts is correct.
And if that model is wrong, your whole strategy is flawed.
Even if the process was sound.
This all leads us straight to the biggest, longest-running argument in finance. What actually matters more for your final results? The big strategic decisions or the active stock picking and market timing?
Right, and this all comes back to the famous and famously misinterpreted Brinson, Hood, and Biebauer studies, the BHB study.
From the 80s and 90s, they looked at a bunch of big pension funds, right?
Huge universe of them. And they tried to mathematically figure out where the returns were coming from. Was it the investment policy, the SAA, or was it the active management, the stock picking and timing?
And what was the big headline finding?
The big one was that when they replaced all the active stock picks with just the passive market index for that asset class, the index portfolio actually performed better than the real one.
So active management was, on average, a net negative.
It was a net detractor from returns. But the number that really caught on, the one everyone remembers?
The correlation.
Yes. They found a correlation of 96.7% between the passive policy returns and the actual fund returns. That translates to 93.6% shared variance.
So the conclusion was that the big strategic decision explained almost all of the portfolio's ups and downs.
It explained the volatility, yes. But this is where the misinterpretation happened. It became this dangerous soundbite.
The one you still hear today. Asset allocation explains 93.6% of investment returns.
Which is just completely wrong. It's a profound misreading of the study. BHB showed it explained 93.6% of the variance of returns, quarter to quarter, not the final dollar amount you end up with.
And this prompted a pretty big academic backlash, right? The asset allocation hoax paper.
Yeah, William Janke came out swinging in 1997, and his critique was simple and methodological. He said that using quarterly data, which BHB did, just inherently hides the massive impact of compounding over time.
How does that work? How does compounding make such a big difference?
Well, think about it. Over one quarter, the difference between a 2% return from the index and a 2.15% return from your active manager seems tiny. A 15 basis point difference.
It gets lost in the noise of the overall market movement.
Exactly. That's the 93.6% variance. But if you compound that tiny difference quarter after quarter for 20 years, the final dollar amounts are worlds apart.
So the volatility might track closely, but the ending wealth could be completely different.
Massively different, which forced the academics to find a more nuanced answer. And that came from a 2000 study by Ibbotson and Kaplan.
What did they find?
They delivered a really sophisticated finding that helped fix this. First, they agreed with BHB that active management was often a raw deal after fees, but they said asset allocation explained about 40% of the variation of returns across funds.
Meaning the active bets explain the other 60% of why Fund A did better than Fund B.
Right, but, and this is the critical part, allocation explained virtually 100% of the level of a fund's returns.
That's the key distinction. Your decision to be 80% in stocks determines the ballpark, the level of return you can even get. Active choices just determine the small variations around that main driver.
This was summed up perfectly by Meir Statman in 2000. He ran a simulation with a hypothetical manager who had perfect foresight in tactical allocation.
So perfect market timing.
Perfect market timing. This portfolio beat the strategic one by a massive 8.1% per year. And yet, Statman still found that the basic strategic allocation explained 89.4% of the return variance.
Wow. So even with literal perfection, most of the ride is still dictated by your basic risk decision.
Statman gave us the perfect way to think about it. Strategic SAA is movement along the efficient frontier. You're just choosing your spot on that risk-return curve.
But tactical TAA is different.
Tactical TAA is an attempt to move the entire frontier. The manager is trying to use skill to shift the whole curve up to find new opportunities. They're hunting for alpha.
And the data on whether managers can consistently find that alpha is, well, that's not great.
It's sobering. It really is. One study looked at the top-performing funds from one decade. In the next decade, only about 28% of them managed to stay in that top quartile.
So over 70% of the best couldn't repeat their success.
Maintaining that skill or luck is just incredibly rare.
So if chasing alpha is so inconsistent, what is the single most reliable predictor of better long-term results?
It's so simple, it's almost boring. It's costs. Fees. Study after study confirms it. The lowest cost quartile funds have the best 5-year performance, and the highest cost quartile funds have the worst. It's the most actionable, surprising insight in all of this.
And that's just because of the relentless math of that fee drag compounding over time.
Exactly. Even a small fee gets charged every single day, year after year, eating away at your principal. If the market only pays you for taking on systematic risk beta, then the smartest strategic move is to pay the absolute minimum you can to get that exposure.
Okay, we've established that managing risk is the top priority. But traditional MPT relies on historical averages, the mean return, and it kind of assumes that market returns follow this neat, predictable bell curve.
Right. And when markets are facing real, heightened uncertainty, relying on that simple average just breaks down.
It's the big warning from institutional investors these days.
It is. Relying only on the median forecast is dangerous. It's like having one foot in a bucket of ice water and one in a bucket of boiling water. On average, you feel fine, but you're getting hurt.
Because recessions and crashes aren't average events. They're binary. They either happen or they don't.
Exactly. So modern firms have moved beyond simple point forecasts. They use stochastic modeling.
Things like Monte Carlo simulations.
Right. Instead of one average number, these systems run thousands, even tens of thousands, of potential future pathways for the market over the next 5 or 20 years.
So the focus shifts from a single expected return to mapping the entire distribution of returns.
Correct. And this lets you analyze not just the center point, but also the fatness of the tails of the distribution. It's a concept called kurtosis.
And financial markets have fat tails.
They really do. It means those extreme events, the big crash, the sudden inflation spike, happen way more often than a normal bell curve would predict. Stochastic modeling bakes that reality right into the simulations.
Which means you can get incredibly specific about what kind of risk you're trying to avoid. You can optimize your portfolio not for the average outcome, but for what happens in the worst-case scenarios.
Absolutely. An investor who is really afraid of losses can say, optimize my portfolio for the best possible return and the worst 10% of all simulated outcomes. That forces a totally different set of trade-offs.
Can you walk us through that BlackRock analysis? Yeah. The difference between the investor who ignores the downside and the one who is downside aware.
Sure. Let's imagine two investors with a 10-year horizon. The first one is the close your eyes investor. They just optimize for the highest possible median return.
The 50th percentile.
Right. So their portfolio naturally loads up on higher growth, higher volatility stuff like emerging market stocks because those have the best median expected returns.
And the result?
The portfolio does great on average, but in the scenarios that are just a little bit below average, it does really poorly. It lacks resilience to even minor shocks.
Okay, now compare that to the downside-aware investor.
This investor uses what's called robust optimization. They prioritize getting better returns in those really bad outcomes, that 10th to 25th percentile.
What does that do to the portfolio?
It systematically pulls them away from those highly correlated growth assets. They have to accept a slightly lower median return, maybe 0.5% less per year.
Glad.
But they get a substantially higher return in those bottom half outcomes. They have purposefully given up some upside in exchange for a portfolio that is much more robust against shocks.
That's the modern trade-off. It's not just about chasing the highest number.
And this extends to specific risk hedging, too. Some investors, like a pension fund, might care more about protecting against inflation than they do about pure growth.
And you mentioned earlier, when we're talking about inflation, simple correlation isn't enough. You have to look at inflation beta.
Yeah, this is key. Correlation just tells you if two things move in the same direction. Inflation beta tells you the sensitivity. It measures how much an asset moves when inflation goes up by exactly 1%. You need high beta for a good hedge.
So if you build a portfolio specifically to have a high inflation beta, what does that do to the overall risk?
Vanguard ran this analysis. They compared a standard 30/70 stock bond portfolio to one that was optimized for inflation hedging, using things like TIPS and commodity futures.
And it worked.
It worked perfectly. The inflation hedging portfolio got an inflation beta of 1.0. It moved dollar for dollar with inflation. The standard portfolio had a beta of just 0.06.
But there's always a trade-off. What was the cost?
The cost was significant. The inflation hedging portfolio had higher overall volatility and, crucially, a much higher maximum drawdown. It lost 32% in its worst period, compared to 28.6% for the standard one.
So you're trading the slow, quiet risk of inflation for a higher chance of a sharp, sudden loss.
It's a precise and necessary trade-off. It's not a free game.
So all this sophisticated theory, whether it's optimizing for downside risk or implementing a systematic tilt, it needs efficient, low-cost tools. And for today's investor, that tool is overwhelmingly the ETF.
Exchange-traded funds, yeah. They've totally changed the game for implementing strategic allocation because they solve that #1 predictor of success we talked about, minimizing fees.
Let's just quickly clarify the basic difference between an ETF and a traditional mutual fund.
The main difference is how they trade. A mutual fund only prices once a day, at the end of the day, at its net asset value or NAV.
But an ETF trades all day long on a stock exchange, just like a share of Apple.
Right, which gives you a ton of flexibility. You can use limit orders, stop losses, things that just aren't available with mutual funds.
And the cost advantage is huge. Why are they so much cheaper?
Two big reasons. First, they just have lower overhead. They don't have the big marketing and distribution costs that mutual funds do. No 12b1 fees.
Okay.
Second, and this is a big one, they don't have to hold a lot of cash on hand. Mutual funds always have to keep cash ready for when investors want to buy or sell, and that cash is a drag on performance. ETFs don't have that problem.
But for people investing in a taxable account, in the US at least, the tax efficiency can be an even bigger deal than the fees.
Oh, absolutely. The structure here is key. With a mutual fund, if a lot of people sell, the manager has to sell stocks inside the fund to raise cash.
And when they sell those stocks, they realize a capital gain.
A capital gain that gets distributed to all the remaining shareholders, creating a tax bill for you, even if you didn't sell a thing.
That's the worst, getting taxed on a gain you didn't even take.
ETFs get around this with what's called an in-kind redemption. Large institutions don't get cash when they redeem, they get the actual underlying stocks from the index. Since the fund never sold the stocks for cash, no capital gain is created.
So you generally only pay taxes when you decide to sell your shares.
That's the big advantage.
Now, beyond just tracking a basic index, we have more complex tools, starting with factor ETFs or smart beta.
Factor ETFs are a great tool for implementing those strategic tilts we talked about. You're moving away from just a market cap weighted index to target specific characteristics that research has shown drive returns.
The factors like value, momentum, quality, size.
Right. It's kind of a blend between passive and active. It's called enhanced indexing. They're still rules-based and low cost, but they use an active screen to overweight stocks with those factor characteristics.
So a value ETF is just systematically buying more of the cheaper stocks in the index.
Exactly. Or a low volatility ETF is buying more of the less bouncy stocks. Because this takes a bit more work than just tracking an index, the fees are usually a little bit higher, but still way, way cheaper than an old school active mutual fund.
Moving on to hedging tools, commodity ETFs are crucial for an inflation strategy, but they come with their own unique risks.
Yeah, this is a critical distinction listeners need to get. You have physical commodity ETFs, like the big gold funds, where the fund literally holds physical gold bars in a vault.
Your share is a claim on that physical gold.
Right. But then you have futures-based funds, which are common for things like oil.
And these funds do not hold barrels of oil.
No, they only hold futures contracts, agreements to buy oil at a future date. And to stay invested, they have to constantly sell the expiring contract and buy the next one. They have to roll the position.
And this exposes you to the term structure of the market.
It does. And if future prices are higher than today's price, a situation called contango, that rolling process costs you money. It's a constant drag on performance.
So your ETF's return can be wildly different from the actual spot price of oil.
It's a huge risk that many people don't understand. You have to know what your ETF actually holds.
Finally, we have to talk about the really high-risk tools, the ones for traders, not investors. Leveraged and inverse ETFs.
LETS. Yeah, these are marvels of financial engineering. They use derivatives to try and deliver a multiple, like 2 or 3 times, or the inverse of an index's return, but only for a single day.
And that single day part is what gets people into trouble. We have to talk about volatility drag.
Yes. Volatility drag or the volatility tax. It happens because these funds have to rebalance every single day to maintain their leverage.
So let's say an index drops 10%, your 3x ETF drops 30%.
Right. Now, the next day, the index rallies back up 11.1% to get back to even. But your ETF is starting from a much lower base. It has to rally 42% just to get back to where it started.
Which you won't. So even if the underlying index is flat over 2 days, the leveraged ETS is down.
Exactly. In a choppy sideways market, the fund is constantly buying high and selling low every day because of the rebalancing. It just destroys value over time. They are absolutely not meant for a long-term strategic portfolio.
And the newest complication here is cryptocurrency ETFs.
Right. We now have spot Bitcoin ETFs, which hold actual Bitcoin, and the older futures-based ones, and they behave differently. But there's a really weird new issue with these called asset dust.
Asset dust.
Yeah. Because of how blockchain works, the fund managers can end up with these tiny residual amounts of other assets, like a microfraction of another crypto token or even a worthless NFT that got sent to their wallet.
And they can't get rid of it.
It's hard to, and it creates all these new legal and tax headaches for the issuer who has to comply with very strict rules. It's a totally unique feature of this new asset class.
So this deep dive started with the truth that diversification is the only free lunch, proven by the math of MPT. The investor's mission isn't to predict, it's to optimize risk.
And we saw how institutions are moving beyond simple static models to these systematic, time-varying approaches. And that while tactical bets can, in theory, create huge performance differences, the vast majority of your portfolio's volatility comes from that initial strategic choice.
And the data is just so clear. Chasing alpha is expensive and inconsistent. The single most reliable predictor of success is just keeping your costs low.
And crucially, using modern tools like stochastic modeling to embrace uncertainty, to move past the danger of the simple average and optimize for the whole distribution of outcomes, especially the bad ones.
It's about making a conscious trade-off, maybe accepting a little less on average in exchange for much more resilience when things go wrong.
And the investor's job is always to connect that theory to their own personal reality. There is no single best portfolio. The best portfolio depends completely on your goals, your time horizon, and your actual tolerance for risk.
But you have to remember that what looks safe can be the most dangerous thing of all.
It can.
Which brings us to our final provocative thought for you to take away. We've talked a lot about volatility risk. But what about the silent killer, inflation?
Right.
The investor who wants to maximize stability. So they put 100% of their money in fixed income, in bonds. The safest choice. The data shows that over 5-year periods, that 100% bond portfolio often has the most periods of negative real returns after you account for inflation.
The market only pays you for bearing systematic risk beta. If inflation is a systematic risk and your portfolio isn't positioned to earn a real return above it, then you're taking on a risk you will not survive long term.
Which leaves you with the ultimate strategic question. If alpha is so hard to find consistently, how much of your time and energy should you really spend trying to beat the market versus just focusing on getting that systematic risk exposure at the lowest possible cost?
That's the strategic decision that matters most.